Welcome back, everyone. So hopefully you've all had enough coffee for a panel about financial regulations. But of course, it's not just any financial regulations. It's the Markets in Financial Instruments Directive, or MiFID. Not the easiest acronym, but I'm sure we've all got used to saying it at this point. To kind of introduce my panelists today, we have Stephen Hanks, the Markets Policy Manager at the UK Financial Conduct Authority, Alan Miller, co-founder and CIO of digital wealth manager SCM Direct, and Jamal Tarazi, Director of European Business Development at Hudson River Trading. And just so you know, if you have any questions for our panelists, feel free to type them up in the app, and then we might get to them later if we have time. I guess just to start off, MiFID was all about transparency and kind of helping the customers know what they're paying for and what they're getting. So, Alan, you campaigned for that before MiFID's implementation. Do you think it's achieved that goal so far?
No, it's very sad, actually, because if you think about it, for over 20 years in the UK, by the admission of the former head of the Investment Association, consumers didn't know the costs and charges. The FCA in 2000 knew that 50% of costs and charges were hidden. We tried via politicians, we tried via regulators to change the industry, change the transparency. The European Commission brought in MiFID II, and the center point of MiFID II is transparency. Now, if customers don't know the costs and charges, there can't be proper competition. Consumers can't make informed choices, and basically consumers are being ripped off every day. Now, when that law came in on January the 3rd, we foolishly thought the FCA would actually enforce the law. And to quote somebody a long time before the FCA, in 85 BC, he said, "The judge is found guilty when a criminal is acquitted." Mr. Bailey said, in response to the RBS scandal, he said, "Justice delayed is justice denied." And yet here we are in October with the vast majority of firms not complying with MiFID II, and the FCA is not enforcing it. We had to produce FOI requests on the FCA, which it tried to deny through public interest until the ICO forced it to reply. And those FOI requests proved that literally a handful of firms have been looked at by the FCA. It also proved that the regulatory and enforcement activities within the FCA are slightly questionable when it gave 6 answers in one reply. And following on from that, it then said that 3 out of the 6 answers were incorrect. Well, my son's at school doing maths. If he got 50%, he'd be given a detention.
Right. I think that's why we have Stephen here. How do you respond to that?
Well, we agree that custom charges disclosure is important and that the MiFID II obligations are a step forward in terms of custom charges. I think there has been an improvement in the way in which custom charges is disclosed as a result of the MiFID II obligations. But on that score, as with other aspects of the legislation, we are currently conducting supervisory work to look at exactly what has happened, and then we'll have to decide what we do off the back of that in terms of additional communication to the industry or enforcement action if there are circumstances which justify that. But we need to go about this, as Andrew Bailey has also stressed, in other circumstances, using due process.
Right. And if we dive into one particular aspect of transparency, MiFID was designed to increase trading transparency, and that's why we've seen new limits on dark pools, and now we have these periodic auctions and systematic internalizers. Now, Jamal, you run SIs at Hudson River Trading. How is that going there?
It's going pretty well. I think it's a new way for brokers and their clients to seek liquidity, and it's a regime that's we don't think it's going to be that large, but it will be an important component of a set of tools that the sell side is going to utilize in seeking better liquidity and at the end of the day, get better prices for their end clients. So what we're seeing is the emergence of periodic auction books, so innovative ways to try and minimize the market impact. The SI regime came out. It was a natural way for trading firms, such as Hudson River Trading and other peers in our group, to offer this liquidity, this unique liquidity, to the brokers and then to their clients. It is absolutely in the spirit of transparency, because the SI regime is the first time where you get to have counterparty transparency. So you can hold the market maker accountable, basically, for the executions that you receive. And that, at the end of the day, is not appreciated as much as some of the other ways that we look at transparency, but is a very, very important component.
Right, right. And I think here we can get to the first polling question, which is, has MiFID increased transparency in equity trading so far? The answers are yes, no, or hard to say, so feel free to put in your answers in your phone. Because I think one thing that a lot of people have noticed, that it seems like so far MiFID hasn't really driven a lot of volumes back to the lit exchanges. We've seen a lot of activity on periodic auctions or SIs. I mean, is that something that you've also noticed, Stephen, and is that something that concerns you?
Well, it's clear that as a result of the double volume caps, we haven't seen a simple shift into using the lit order book. It's the systematic internalizers, it is the periodic auctions, and also large in scale transactions. But whilst the particular shares between each of those categories, I think, are something that we didn't know quite how that was going to work out prior to the legislation coming into force. I don't think it's a surprise to us that people are continuing to attempt to limit the impact of their trading and to use those forms of trading which they think minimize their impact, as opposed to using necessarily central limit order book. But we are doing some supervisory work, talking to various of the systematic internalizers, both bank-operated and electronic liquidity providers. And also, as you will have seen from the speech that Stephen Mayor, the head of ESMA, gave last week, ESMA is looking at periodic auctions and is likely to publish a call for evidence on that. I think some of the issues there are looking at issues around broker preferencing, pegged to the middle orders, and the length of time which auctions run, and just looking and asking questions about some of those issues.
Right. And if we look at the polling answer here, I guess most of you have stayed diplomatic. I considered briefly that maybe I should take out the hard to say option just to force everyone to pick something. So I mean, most of you still think it's probably hard to say. Some of you say it hasn't increased kind of transparency. Because I guess the big picture question here is, I mean, as Jamal mentioned, I mean, do you think that the use of kind of SIs and periodic auctions is a sign that maybe transparency hasn't necessarily improved, or do you think kind of that's not the aim of the regulations in the first place?
I think one has to look a little bit broader to understand what transparency really means. If you just define it as trading on the central limit order book of an incumbent exchange, then clearly that has not happened. But there's a reason why that is so. I think more fundamental than just answering a question about transparency is understanding, are we, by we I mean the end investor, are we getting better execution when we try to attempt to get prices in the marketplace? And at the end of the day, everything should get measured basically on the performance to the parent level order. Some orders are just too large to be done in one clip. We know this. It might take, for some orders, it's multiple days. For some orders, it's on the order of hours. On some orders, it's minutes. On other orders, it's just an immediate execution. So one has to find the right tool for achieving that particular execution. And I would say that the transparency should go into whether we're able to better measure the performance of the transaction on the executions. That's the bottom line for me. And I think we're sort of slowly going in that direction. The industry has to adapt, it has to learn, it has to consume all the new data that's coming in, and that does not happen overnight.
Right. And kind of moving on to like another major topic in MiFID, which is of course research. So MiFID was supposed to kind of unbundle costs of regular brokerage services and research, and of course that's completely upended the business model for sell-side research. So here we have the next polling question, which is how has MiFID II affected analyst coverage so far of equities? And the answers are, has it boosted coverage, reduced coverage, or do you think it's had no effect so far? Stephen, has the FCA looked into how much analyst coverage of stocks has shrunk, and is that worrying for you?
Yes, we sent a questionnaire to buy-side firms asking about that. We're currently looking through the responses that we've got to those. I can't say anything about that at the moment. I think the problem with the question is that the research reforms covered a broad range of research. Clearly, prior to their introduction, there was a particular concern about the impact on the research for smaller companies, and that's something we are particularly looking at. And also, the research reforms covered not just equities, but also credit research, and other types of commodities and derivatives research. And so I think we need to look more broadly, and there may be different stories across different areas of the market. I see certainly from the external evidence that we have seen, I've seen some things, again, claiming that there has been a reduction in research on smaller firms. I've seen some other external research suggesting that actually hasn't been the case. So, as I say, we're now asking buy-side firms themselves to get a better view of what actually is happening.
Right, and so we have I guess one unscientific data point here. So most of you, do you think that MiFID has reduced coverage so far? And I think a lot of the concern has indeed been more in terms of small and mid caps, because I think a lot of those companies are worried that if they get less coverage, then it might be harder for them to raise capital in the future and to kind of stay on the radar of buy-side investors. And here we have a chart, kind of another point of reference for everyone. So this is the number of analyst ratings on the Stocks Europe 600 constituents. And we can see that it's really dropped a little bit this year. But of course, the chart kind of also shows that it's kind of been on a downtrend for several years now, which is probably also kind of people's experience here. Now, the aim of the MiFID rules were to, increase transparency for consumers, but it does seem like it has shrunk analyst coverage. Do you think that is worrying for you, Alan? Is that also bad for investors in some way?
Well, I think that there's probably a difference between the large cap and the small caps, because in the large cap, prior to this, there was a lot of duplication of research and probably a lot of Me Too research. Whereas in the small cap, mid cap, it probably has much more significant effect on companies and the ability to raise finance. So I think it's probably a positive that a lot of analysts who weren't really analyzing, they was almost just copying the results presentation. There was another note on Vodafone or whatever it is on the large cap. On the small cap, mid cap, then that is important, and companies do require a proper functioning market with proper research to help institutions within those shares. But coming back to transparency, it was Lord Miners, or Paul Miners as he was in 2000, who actually said clients should not be paying the same thing twice. Because what happened prior to MiFID II were clients were paying the fund manager to research stocks, and then the fund manager was essentially paying the brokers via inflated commission charges to research stocks. So I think it's a positive that the client now knows they are simply paying the fund manager to do their job rather than being subcontracted and double charged essentially. But it is important that small caps and mid caps have proper research coverage for a fully functional market.
Right. And I guess one particular question for Stephen. Anecdotally, it seems like a lot of large firms have cut the cost they're charging for research. Is that something you're looking at? And is research that's priced too cheaply, is that going to constitute inducement as well?
Certainly, we are looking at the pricing of research. Clearly, during the course of last year, in the price discovery process, the price of research fell. There might be a level at which we would consider somebody's pricing strategy to constitute an inducement, but I say we just need to collect the information and look at exactly what people are doing before making any judgment on that.
Right, right.
Just interject. I mean, there's also one thing that's a bit missed in all of this, as well as MiFID II kicked in, is indirect costs. If you take a look at, for example, the market data costs that the exchanges are providing, that's becoming a big problem for everyone in the industry. So much so that certain exchanges stopped even consuming certain the market data from other exchanges to just show and understand where the market as a whole is trading at, to get a full pan-European picture, so to say, of the instruments trading. That should also be quite a big concern for the regulators, I believe. So,
well, I think the provisions of MiFID dealing with the pricing of data and also clearly the consolidated tape haven't worked terribly effectively. The reasonable commercial basis provisions were watered down during the negotiating process. But it certainly is something that we, again, are looking at.
Right. And of course, no panel these days is complete without kind of a question on Brexit. So this one's for Stephen in particular. I mean, MiFID are EU regulations, so what does Brexit mean for the future of MiFID in the UK?
Well, the Treasury published on Friday a statutory instrument on shoring various aspects of MiFID II, and we have today published a couple of consultation papers, one on a temporary permission regime and one on changes to the handbook and to the technical standards in MiFID II. I think the main challenge that we see in Brexit for MiFID II is in relation to the transparency provisions. You'll see from the Treasury legislation that's an area where there is a departure from just crossing out EU and putting UK in to the legislation, because if we end up with different transparency thresholds in the UK from the transparency thresholds in Europe, that could lead to market distortions. So we're wanting to try and ensure that there isn't distortions arising from the transparency regime, and have provided for some degree of flexibility in the way in which that will operate. But in part here, it's very difficult to predict what we will do domestically, because we don't know what will happen within the EU. We don't know how the EU will change its legislation. There was a speech by the head of the French regulator at an AFME conference recently where he suggested several areas of MiFID which he thought should be potentially changed post-Brexit. So it's not a case simply of MiFID being unchanging in the EU, never mind what happens in the UK.
Right. And we kind of have a great question from an audience member here, because I guess the discussion so far has focused on equities. I mean, how do you guys see the impact on fixed income, MiFID's impact on fixed income compared to equities?
On fixed income, certainly the transparency provisions, certainly the pre-trade transparency provisions, were relatively unambitious in terms of the number of bonds that were going to be covered. Therefore, I think certainly from discussions we've had with market participants, they seem to think that there has been, they were concerned prior to the implementation of MiFID that the transparency provisions would have an adverse impact on liquidity in the way in which they were trading. That doesn't seem to have occurred. I would expect over time, and again, this was reflected in Stephen Mayor's speech last week, for the provisions to be revised and for more bonds to be brought within the scope of transparency provisions. But certainly from where we are at the moment, the impact seems to be, there is more publicly available information, but the impact in terms of any adverse impact on liquidity doesn't seem to be there.
Right. And to kind of move on to the very last polling question, because I think you can see that behind all these rules, there could be a difference in effect on larger financial firms than on smaller ones. Like, for instance, a larger asset manager might be able to do more internal research, or a larger firm might be able to kind of introduce a stronger suite of research products. So the last question is, does MiFID help large financial firms at the expense of the little guy? And again, I've given you the option to say hard to say, in addition to yes or no. What do you guys think about that?
Well, I think coming back to the costs and charges, if you think about it, a lot of smaller firms tend to take compliance very seriously, have external compliance consultants, so there is no kind of debate. They follow the rules. So if they're having to compete with much larger firms, which the FCA, for whatever reason you'll have to justify later, is choosing not to enforce the rules, then you can't have proper competition. And it's unfair. I'm sure there's large numbers in the room who are complying with MiFID II. So why should they be disadvantaged having to compete with firms that are not showing the costs and charges in the same way as them? It's patently unfair. It's unfair to the consumers, and it's unfair to people in the room who actually choose to comply with the law.
I think from a trading perspective, it's probably clear all the added requirements to comply with MiFID II requires a large-scale operation these days. So it's definitely, if one is a new entrant into this field, I see that as a tremendous challenge for such an entrant to come in and succeed or thrive. It's a time, actually, we're seeing the opposite. We're seeing consolidation within the industry. We saw Hudson River Trading purchase Sun Trading and other participants in the marketplace that are doing so. Scale definitely helps, and so I would clearly put it in the yes categories.
Right, and it seems like most of the audience agrees with you as well. I guess just to conclude, I mean, in one sentence, has MiFID net been good for investors so far?
Yes, I think it has. To use more than one sentence, inevitably, given its scale and complexity, MiFID implementation was going to be a process rather than an event, and it will play out over time. But I think definitely it will work to the advantage of the investor.
My answer is yes, it will be when the FCA decide to enforce it.
I think it's too early to tell. I think it definitely has the potential to be much better as people learn to better deal with the regime, to evolve their business, their strategy on how to get liquidity, et cetera. So it definitely has the potential to be.
Cool. That's a great note to end on. Thank you so much.